Are you wondering what might trigger an IRS audit? I'm here to reveal the top red flags that could put you on the IRS's radar. In this video, I'll share the most common IRS audit triggers and give you tips on how to avoid them so you can keep your tax returns safe from unwanted scrutiny. As a tax attorney with 12 years experience, I've seen these red flags lead to audits time and time again. Understanding these audit triggers could save you a lot of hassle and a lot of money. By the way, I'm Brad Paladini, and I've spent over a decade helping people reduce their audit risk and handle tax issues when IRS audits do happen. The first thing we need to understand is how tax returns are selected for audit by the IRS. And there's a couple different ways. The most popular is because your DIF score was too high. So what is a DIF score? When you file a tax return, the IRS will look at your return and they will compare it to similar returns. So let's say you are a contractor and you file a Schedule C. The IRS will compare your tax return to other businesses that are similar to yours. And they have different ratios for expenses and different expense categories. And they will give you a score based on how far away you are from the norm. The higher your DIF score, the more likely you are to be audited. Simply making more money increases your DIF score. Now, the IRS doesn't exactly release how the DIF score is calculated because they don't want people to reverse engineer and try to avoid the audit. But based on available information, we have a pretty good idea. So DIF score is certainly the most popular way for you to get selected for an audit. There are also some random audits where maybe there's no particular rhyme or reason to you getting audited, but in my experience, that's pretty rare. There's almost certainly a reason. The other most common reason for the IRS auditing you is the X factor. So this could be an ex-spouse, an ex-employee, an ex-business partner who calls the IRS and rats it out. They say, hey, something fishy is going on. I know they're underreporting income. I know they're overreporting expenses, and that could trigger an IRS audit. Okay, so what are the things on the tax return that would increase your chances of an audit? The first, excessive deductions. So what do we mean by excessive? Is there like a certain number, like if you're deducting 100,000, that's automatically going to get you audited? No. It really depends on the proportionality of the deductions, particularly for businesses. So if you have a business and you're reporting, $100,000 of gross revenue and you're reporting $500,000 of deductions showing a massive loss, that's going to increase your chances of an audit. Because the IRS is going to want to know, hey, how is this person paying for all of their personal expenses? They got to live, they got to eat while losing $400,000 a year. And for some businesses, it's perfectly reasonable, right? You're a new business, maybe you're a startup and the expenses are just kind of flying out and you're trying to raise capital. For other businesses, maybe they're just being overly aggressive with their deductions. So excessive deductions in compared to your income is something that will increase your DIF score and also increase the likelihood of an audit. There are also certain deductions that the IRS just hates. They won't tell you they hate them, but I promise you they do. So the first one is travel expense. So if you have a disproportionately high travel expense, you are at an increased risk for an audit. Again, what do we mean by disproportionately high? Well, the IRS will look at your travel expense and compare that to the travel expense for other businesses who are similar to yours. The IRS hates this expense because travel can sometimes be a gray area where maybe the trip was partially business, maybe it was partially personal, and so it is ripe for abuse. And you're going to see a pattern here with the deductions that the IRS hates. So if your travel expense is disproportionately high, even if your total expenses aren't necessarily disproportionately high, that would increase your chances of an audit. The second deduction that the IRS hates are meals, again, for the same reason. Are you going out to eat with a buddy and having a drink and buying a nice meal? Or is it actually a business-related expense? They won't know from the tax return which it is. And so if your meal expense is high or disproportionately high, the IRS may want to take a second look. Last but certainly not least, the auto deduction. This is super popular on like TikTok and Instagram. Everybody wants to buy a freaking G-Wagon and write the whole thing off year one. IRS hates this. Again, yes, for some businesses, buying a vehicle and depreciating it all in the first year is completely legitimate. But if you're buying a vehicle for your business, but also driving it 40% of the time personally, you're not entitled to take the entire deduction. You're going to have to split the baby, right? If it's personal use, you can't deduct that on your business tax return. The IRS knows people love to abuse this particular deduction. So if they see a disproportionately high auto deduction, that will increase your chances of an audit. And again, no one thing is going to automatically cause an audit. The IRS kind of looks at the return, looks at the expenses, looks at the income, and comes up with this DIF score to rate your tax return and decide whether or not to audit it. One of the other reasons we see for an audit are just mistakes. I've had several people literally handwrite their tax returns and they add numbers correctly. Things aren't calculated right. There's just simple math errors or inconsistencies, and that too can trigger an audit. So if you're gonna do your own tax return, at the very least, please use some software that will kind of prevent some of these simple math errors. I personally recommend always using a tax preparer to prepare your return. I'm a tax attorney. I've been doing this for 12 years. I hire a CPA to prepare my return every year. Just having another set of eyes on it is really going to prevent those silly errors that could cause an IRS audit. So we've talked today about how the IRS selects audits, primarily through your DIF score, but also sometimes the X factor can also be totally random. That happens too. We talked about disproportionately high deductions, disproportional to your income or maybe to other businesses that also operate in a similar industry. And then we also talked about the specific deductions that the IRS just hates. They won't tell you they hate them, but again, I promise you, they do. If this video is helping you stay audit free, hit that like button. It helps more people get the tax tips they need. If you want help reducing your audit risk, click the link below to book a free consultation. My team and I will review your situation and help ensure your return is as audit proof as possible. Or if you're experiencing an audit, feel free to reach out.